Hello, I'm Larry Pond, and today we're going to talk about the tax aspects of selling your home. Well, first of all, a little bit about me. I'm Larry Pond. I'm a CPA, a personal financial specialist, a CFP, an enrolled agent, a United States Tax Court practitioner, and an accredited estate planner here in Redwood Shores, California. I've been in practice since 1986, so this is my 36th tax season, and I really enjoy talking about taxes to tax professionals and financial advisors. So let's get started. So today we're going to talk about how do I calculate the profit from the sale of my home. Well, first of all, let's start with the formula. So the formula is the sales price of the home minus the cost of basis, the selling expenses, and the exclusion. So once you subtract those out, that would give us our taxable gain, if any. And what documentation do we need on the tax return? Well, we're going to need Form 1099-S. That's generally a form we get from the title company, and that should agree to the sales price of the property. That's the proceeds from real estate transaction. And any gains can be reported on Schedule D, capital gains and losses, and help figure out what the gain is going to be. The detail would be on Form 8949, sales and other dispositions of capital assets. So in your tax software, when you're inputting the sale of the home, make sure you check the box that there is a 1099-S. Otherwise, the software may not report the sale of the house if there's no taxable gain. If you leave it off the tax return and if there's a 1099-S, there's a very good chance your client will get a CP 2000 notice. So one way to avoid that is to make sure in your software, check that box in your data entry. So in terms of reporting the sale, first of all, we start with the closing statement. It used to be called the HUD-1 statement, but now it's the closing statement. It's got a couple of columns. On the top, it shows the sales price, and there might be some sale of personal property with the sale of this house. That could be furniture, it could be a boat, it could be a plane, it could be a car. And then subtracting from the sales price would be the selling expenses, most notably the commissions from the realtors, the buyer's agent or seller's agent, the transfer taxes, the escrow fees, city and town taxes, county taxes, and assessments. Other settlement charges could be paying for a survey to figure out the boundaries, pest inspection, pest repairs, septic inspection, septic repairs, property inspection, termite inspection, chemical treatments, title charges, and settlement closing fees. Now, there could be some money you're spending to get the house ready for sale, to enhance its curb appeal. So that could include staging or repairs or other types of expenses, such as cleaning the carpets, painting it, fixing up the landscaping, those kind of things. In many cases, instead of paying for it ahead of time, if the vendors would agree, and especially in a hot real estate market, they're pretty open to it, is that you negotiate with them saying, look, you'll get paid when the house is sold. And it's subtracted from the sales price. So that can include your stagers, your repairs, and all those vendors. So expenses you incur to improve the sales price of the house. Now, there's other reductions in the amount due to the seller. Now, this doesn't reduce the gain. That's paying off the mortgage. That's not going to reduce the gain. Any interest and any charges the bank might charge, property taxes, county, city, town property taxes or assessments. And the net amount would be the amount due to the seller. So that's a really important document to get from the client. So let's talk about qualifying for the exclusion. It's Section 121 exclusion. There's two very important tests, the ownership test and the use test. So you have to own and use the property for a period aggregating to at least 2 years out of 5 years prior to its date of sale. Now you can meet this ownership and use test during different 2-year periods. It doesn't have to be the exact same time, and that happens. You must meet both tests though during the 5-year period ending on the date of sale. So 2 out of 5 years, you have to own and use the home as your principal residence. So most importantly, is you're not eligible for this exclusion if you exclude the gain from the sale of another home during the 2-year period prior to the sale of your home. So if you happen to sell another piece of real estate, wait at least a couple of years. Now, where do we see this the most often? It's older people who get married, each have their own house, and they say, let's get our own together house. So the husband will sell his house, the wife will sell her house, but wait 2 years if you want to take advantage of this exclusion. So we need to work with our clients to plan carefully. Otherwise, the second sale is going to be fully taxable without the use of the exclusion. So be aware of that. We run into a situation a lot. Now, how can you suspend the 5-year test period? That can occur if you're a qualified official on extended duty in the uniformed services, the foreign service, or intelligence community. And you can elect to suspend the 5-year test period for up to 10 years. A qualified official extended duty is if it's more than 90 days or for an indefinite period at a duty station that's at least 50 miles away from your main home or residing under government orders in government housing. So what's the amount of the exclusion? It's up to $250,000 on the sale of a home if you're single, $500,000 if you're married filing jointly. So what does that mean? So we calculate the gain, the sales price minus expenses, minus the bases, and we come with the gain. We subtract from that gain $500,000 if you're married filing jointly. If that's less than zero, then there's no capital gains tax. I always highly recommend reporting it though on the 8949, you'll net out to zero. You can't claim a loss. However, if the gain is more than $500,000, then there will be a taxable capital gain. And that's where you need to do some tax planning, such as should we harvest losses in our portfolio? What other tax planning can we do to help lower the tax bill? Now, what's not going to qualify for the exclusion? The house was not your principal residence. If it's a vacation home, a second home, you own the home for less than 2 years. You did not live in a home for at least 2 years in the 5-year period. You already claimed the exclusion in less than 2 years, or you both acquired a house through a 1031 like-kind exchange in the past 5 years. That's if you rolled a gain from a rental property to the home you're living in, but let's wait 5 years, or you're subject to the expatriate tax. That's if you decide to give up your US citizenship. The type of real estate that would apply, single family homes, condominiums, townhouses, cooperative apartments, mobile homes, and houseboats. So these qualify for the exclusion. Now, what about an RV or a big boat or a mega yacht or something like that? Would that qualify? That's a good question. I think the determination is helpful from your state. If the state deems it as personal property, then it's not going to qualify for real estate. How would you know that? Because they're charging personal property tax, not real property tax. So that's how you would know. So you have to live in the house for at least 2 years. It's got to be your main home. And many of our clients have more than one house. So it's going to be the facts and circumstances. Hopefully they keep good records of where they are residing. Now, what if it's less than 2 years? What if you live in the house for less than 2 years? Is there an exception to this rule? Yes, and we'll talk about that right now. That's in case of work-related situations, health, or unforeseeable events. So a work-related move would be you got transferred to a new job at least 50 miles farther from home and only needs to apply to one of the spouses. So example is an executive I know, he bought a house in Seattle, Washington. Well, his employer says he doesn't have a job in Seattle, Washington anymore. So he moved to the San Francisco Bay Area. The Seattle market was pretty hot. He sold it both within 2 years. But because he got a new job here in the Bay Area, which is more than 50 miles away, we were to use a partial exclusion. So you didn't have to pay tax on the entire gain. Or a health-related move to obtain, provide, or facilitate diagnosis, cure, mitigation, or treatment of disease, illness, or injury to yourself or a family member. Now, they don't have to live there, but the family includes parents, grandparents, children, brother, sister, in-laws, uncle, aunt, nephew, and niece. And you need a letter from a doctor to recommend a change in residence. Now, this is not just physical health, also mental health. We took advantage of this for someone where the wife the house just wasn't working for her. It was causing her all kinds of severe anxiety and all kinds of emotional and mental problems. So we got documentation from the various healthcare professionals documenting that. And they sold their house. The market was pretty hot here in the Bay Area. So they bought another house that's more suitable for her, and she's now much, much happier. And that's helpful too. If you can document that she's better now, she's cured or is no longer having those emotional problems and all that. So that's good documentation. The more documentation you have, the better. Or you have unforeseeable events. The home was destroyed, it was condemned, or you suffered a casualty loss. It could be man-made, it could be natural, or an act of terrorism. But it doesn't matter if the loss is deductible or not. As you know, the Tax Cut and Jobs Act changed the rules for casualty losses. You can only claim a casualty loss if it was part of a federally declared disaster. Well, in this case here, you had a casualty, it didn't matter if it was deductible or not. Or you, your spouse, co-owner, or anyone else for whom the house is a residence, died, became divorced or legally separated, gave birth to 2 or more children from the same pregnancy, became eligible for unemployment compensation, became unable to pay basic living expenses. And other facts and circumstances. You want to document all this. The situation causing a sale arose during the time you own and use the home as your residence. You sold your home not long after the situation arose. You could not have reasonably anticipated the situation when you bought your home. You began to experience significant financial difficulty maintaining the home. The home became significantly less suitable as a main home for you and your family for a specific reason. So again, you want to document as much as you can that way, because there's a very good likelihood of an IRS audit. And that has happened. I've seen that happen, but the audits go quite well if you get the documentation. Don't wait for the IRS audit to occur. Have it ahead of time. If I'm doing an amended return, I include all this documentation in an amended return, because whoever's looking at it will have all that information there, and that might help circumvent an audit. But if an audit happens, we have all the documentation. So it's really important to have the documentation. In the case of a divorce, if you transfer the house to a spouse or an ex-spouse, it's part of the divorce settlement, the property settlement. In that case, there's no gain or loss at the time that occurs. So whoever's getting the house doesn't have to pay any capital gains tax, and there's nothing to report. There's carryover basis and all those sorts of things. But later on, there's some other considerations when the house gets sold later as a single person. And there's some other rules for divorced couples when they still own the house together. If the spouse or ex-spouse is a non-resident alien, there could be a gain or a loss from this transfer. So let's close with calculating the cost basis of the home. That's really important. And it's really frustrating when we're dealing with clients who have never kept track of it. And they ask us what the tax is going to be. And I said, well, what's your basis? And you get a blank stare. So hopefully they have this documentation. Every time we have a new homeowner, keep all your documentation in a folder or something like that. Basis is your purchase price plus closing costs, refinance costs, because you know refinancing is not free, and improvements you made to the property. So we need the documentation, receipts, canceled checks, invoices, contracts. The more, the better. I always recommend taking pictures of the house too, saying, here's the new roof, here's the addition, here's a new kitchen, here's a new bathroom. Some clients here in the Silicon Valley, their houses show up in one of those magazines, and keep an issue of the magazine where they showcase the house. It's like, whoa. And sometimes the article even tells you how much they spent on it. On Fridays, it's the real estate articles in the Wall Street Journal, and that's always fun to read how much people spend on their remodeling. So basis includes the fees and closing costs, all the fees, the legal fees, title search, recording fees, and all that. Now, there's some fees that would not count towards the basis, insurance premiums for fire, rent, utility charges, mortgage insurance premiums, mortgage interest, real estate taxes, homeowners association dues. Construction, cost of land, cost of labor and materials, but not your own labor if you did the work, not the labor you did not pay for. You can't make those numbers up. Hopefully you have documentation. Architect's fees, permits, connection charges, legal fees. Now the additions, I'm not going to go through these in detail. You got additions, a new bedroom, bathroom, deck, patio, lawn and grounds, exterior improvements, insulation, systems like HVAC, security systems, plumbing, the interior, kitchen remodels, flooring, wall-to-wall carpeting. Controversially, what are not improvements? Repairs and maintenance. Many tax court cases on this of what's not a improvement. Painting, by definition, is a repair. Fixing leaks, holes, replacing broken hardware. Improvements are not part of the house anymore. You don't count those. Anything of a life expectancy of less than a year. If you claim solar energy credits on solar panels, you can't double dip. So this is a very important exercise. Hopefully not during tax season, but before tax season, get your clients busy on figuring out the cost basis. An important resource that's very helpful is IRS Publication 523. I encourage looking at that. It's got worksheets in there. It's got some detailed explanations, and it's worth looking at. Well, thank you for coming today. I hope this was helpful, and I look forward to talking to you again. Thank you very much, and have a great day. Bye-bye.